This client recently sold an investment property and made a gain of 800 grand. So they should have been hit with a $200,000 tax bill, but they put one tactic into place that got that down well under 100K, delivering a tax saving of almost $120,000. Now, how capital gains tax works in Australia is that if you've held an investment like a property for longer than 12 months, you get a 50% discount on the capital gain. So they made an 800K headline gain, but with the 50% rule, that reduced down to $400,000. This $400,000 though is essentially taxable income that adds on. It's like your employer pays you a 400 grand bonus. So it all gets taxed at your top marginal tax rate, which means a pretty significant amount of tax. That's where the $200,000 tax bill would have come from in this case. Now, for these guys, the property was owned in joint names. So that means that the gain is essentially split. The $400,000 gain, $200,000 to each person. Now, if you're an employee, there is a limit to what you can do to reduce your tax bill, but you can make tax deductible contributions to your super fund of $27,500. That's in this current financial year from 1 July, that is increasing to $30,000. But if you haven't used that full tax deductible contribution limit in previous financial years, you can do what's called a catch-up contribution and make a big chunky contribution in one financial year, which is all tax deductible. Basically, over the last 5 years, that would be $130,000 less any money put into your super by your employer or by salary sacrifice. For this couple, one was self-employed and so hadn't really been putting any money into super, so they could use almost the full $130,000. For the other, they were able to put in almost 90 grand. Now that effectively reduced their total taxable capital gain down to $180,000 from $400,000, meaning that the tax bill was then well under 100 grand. Now, super might not be the first strategy that you think about if you're trying to save tax, because most people are reluctant to tie up money into their super that they can't access until they're really old. But reality is that the money is much better, in my opinion, in your super fund than it is in the ATO's bank account.